Look, when it comes to it, he's not calling the death of the dots, but he says, look, the world has changed, and this is about forward guidance, and he's channeling, we should be more Greenspanian in our policy in that way, relishing the deliberate opacity. Scott, have we been over forward guidance? Do we need a Greenspanian era to re-emerge?
No, I don't think we're over forward guidance. I think it's a very important part of the communication strategy the Fed has with the markets, and as witnessed by their ability to raise rates pretty methodically over this last few years, it suggests that that's a good model going forward. I do think, though, that the terminal rate is a relevant part of the conversation for bond investors and for equity investors, and that terminal rate now sits just below 3%. And what we would suggest is, as we move through time and as the economic picture continues to develop, that terminal rate could move higher, so above 3%, as much as 50 to 75 basis points higher than it is now over time. And that's going to be a relevant input for investors, not today or tomorrow, but as we go through the next couple of quarters.
So, Scott, when we look at the future then of dots, and dots go is the function on the Bloomberg that sort of replicates what the Fed is forecasting, do you think this is this a distraction then from where you think we should be focused, which is the terminal rate? This produces too much conversation about the very near term when we should be focused further along the curve.
I think that's right. I think that the conversation about the next kind of 6 quarters of Fed rate hikes is, I think, less relevant in sense of where are we going in the longer run, what is the terminal rate going to be, and how is the market going to adjust. These comments about the yield curve inversion, I think, are important. Partly because the Fed thinks they're important, but also because we have to realize the dynamic here. If we get a number of rate hikes that causes the 2-year to 10-year curve to flatten, that's normal for this period of monetary policy withdrawal. Obviously, longer term, if that gets inverted or stays inverted, that could suggest economic activity is going to fall off. But for us, it's really about not next year's rate hikes, because that's pretty much baked in the cake. It's really looking forward to where the terminal rate goes, implications for the dollar, implications for emerging markets. I think that stuff is incredibly important.
Scott, you said that you need to review where the terminal rate might be. Where do you see that potentially being now, given all of this rhetoric? Bostic doesn't want the curve to invert. That's what they're focused on. What does that mean for you for the terminal rate?
Well, I think what we would suggest is the terminal rate should be higher than it is now. So if it's around 286 to call it 2 3/4 to 3%, we would suggest that should be higher as we move through a period of stronger economic development. But we're not going to get that much of a change in that in the very near term. Obviously, the market has been reacting to a series of Fed rate hikes, particularly the front end, with front end rates around 2.5% in the U.S. Investors have reconsidered what their hurdle rate is for investment. So what is the return that they need on other types of assets, given that short rates, risk-free rates, have moved up so much? I think that's part of the reason why we've seen weakness in emerging markets, for example, because investors are expecting a higher return. And so, Manus, that's how it factors into our view, because as that terminal rate increases, investors are going to demand higher return on non-risk-free assets as we go through time. And that's why, for example, the U.S. Ag has had about a 3% negative return year to date, which is a pretty big move, particularly in the recent history of fixed income returns. Excuse me.
And with that in mind, and by the way, you flagged that up to me earlier before we went to the break, and you said, look, actually, it's been a bit of a tough old time in fixed income. Have a look at this, Scott. What we've done here is we put it together. This is 10-year rates relative to their peers around the world. You're getting 1% extra at the moment. Will that spread continue to widen? Do you think that differential, do you think we're still got mileage in the divergence to play here?
Yeah, I think for international investors looking at that chart, the currency hedge, the cost of currency hedge back to your home currency, so euro investors, for example, you have to take that into consideration. But as a sign of interest rate differentials, what's happened is that the U.S. has sold off much more than European counterparties, particularly the Eurozone and also the UK market. We see that as an opportunity, which is to say that I actually believe that European rates, so pan-European rates, not just euro area rates, the UK rates, Eastern Europe rates, those will start to converge towards treasury rates as the economic activity in Europe or outside of the U.S. gets more focus from investors.
So you see the rest of the world kind of catching up with the US. Where does that leave you in the FX markets then, as particularly on the dollar? Because we saw the dollar recoupling a bit this year, didn't we, to that Fed rate hike story, with interesting implications for other parts of the world. But where do you see the dollar from here?
Well, we've had, so to keep it in frame, we've had a very strong dollar over the last several quarters against emerging markets, against the euro, more recently, and even against the British pound. What I would say is I would look for the emerging markets to be an interesting opportunity. So emerging market currencies out of the dollar, so a weaker dollar relative to emerging markets, in particular because of the volatility that we've had, the valuations, but also the economic growth story continues to be positive in EM.